Welcome to this explainer. Okay, today we're cutting right through the noise to decode the 2026 cryptocurrency landscape. No hype, no wild promises, just the data and a pragmatic playbook for modern investors. So whether you've been kind of sitting on the sidelines watching this all unfold, or you're already in and looking to refine your strategy, you are in exactly the right place. Let's dive in.
It's the massive question on literally everyone's mind, isn't it? I mean, after more than a decade of completely wild market highs, dramatic crashes, and just nonstop headlines, is cryptocurrency actually still worth investing in as we navigate 2026? Early investors, they witnessed these extraordinary thousands of % returns, but they also had to weather some absolutely extreme volatility. So the answer today, it really isn't a simple yes or no. It requires a much deeper, more structured look at what this asset class has actually become.
So here is our roadmap for today. We're going to cover the 2026 crypto landscape, the top digital assets, risks versus rewards, crypto versus traditional finance, and then we'll wrap the whole thing up with a solid beginner's playbook.
Section 1. The 2026 crypto landscape. From a niche experiment to a full-blown global asset class.
To truly understand where we are right now, we kind of have to define our terms. Cryptocurrency is simply digital money secured by cryptography and powered by a decentralized, transparent, and tamper-resistant blockchain. And the real emphasis here is on that word decentralized. Because unlike traditional fiat currency that's just printed by governments, these operate on networks maintained by thousands of computers worldwide. Every single transaction is recorded on a blockchain, creating a digital ledger that essentially cannot be tampered with. Back in 2009, Bitcoin launched to, well, very little fanfare. But over the 2010s, the tech evolved incredibly fast, bringing us things like smart contracts and decentralized finance, or DeFi, which effectively digitized traditional banking services, like lending and borrowing, but without the middleman. But here's the crucial shift for 2026, institutional adoption and market maturity. We aren't just talking about individual tech enthusiasts in their basements anymore. Today, massive asset managers, hedge funds, and publicly traded companies are heavily involved, and that has brought an entirely new level of public confidence and structural maturity to the market. Section 2. The top digital assets. Let's cut through the noise. When we break down the big three, notice how completely different their purposes actually are. Bitcoin's primary use is as a store of value. It's essentially the digital gold of a portfolio. Ethereum, on the other hand, acts as the ecosystem leader for decentralized applications through its smart contracts. And Solana? Well, that's the emerging tech built for lightning-fast, low-fee transactions, which is really driving gaming and AI. So they aren't actually competing to do the exact same thing. They are building entirely different parts of the digital economy. Section 3. Risks versus rewards. The absolute realities of volatility. Okay, let's start with the rewards, because these are the undeniable advantages that keep pulling investors in. First, you've got that high long-term growth potential. Historically, crypto has delivered some of the absolute highest returns among modern asset classes. Second, it offers incredible portfolio diversification, often behaving quite differently from your standard stocks and bonds. Third, 24/7 global accessibility. Wall Street might sleep on the weekends, but crypto, it literally never does. You can trade digital assets worldwide absolutely anytime. And finally, you get direct exposure to cutting-edge blockchain innovation that could fundamentally reshape global finance.
Now, to understand how to capture these rewards responsibly, let's look at a real-world example straight from our source material. Meet Michael. He's a software engineer. Now, Michael fully believed in blockchain technology, but rather than betting the farm, he chose a very specific number, 5%. He allocated just 5% of his total investment portfolio to Bitcoin and Ethereum.
So why is that 5% so important? Well, this strictly disciplined allocation allowed Michael to capture long-term growth without ever threatening his overall financial security. Over the years, sure, his crypto investments experienced sharp gains, and yeah, some pretty significant declines. But because it was only a small fraction of his broader, diversified portfolio, his index funds, his retirement accounts, the inevitable market volatility never threatened his peace of mind. He managed his risk responsibly. But we really have to contrast Michael's disciplined approach with the stark reality of the risks involved. Extreme price volatility is just a daily reality here. An asset can easily jump 20% one week and plummet 30% the next. Plus, there's ongoing regulatory uncertainty as governments all over the world try to figure out how to tax and govern these assets. We also absolutely cannot ignore the security risks. Exchange hacks, phishing scams, and lost private keys, those are very real threats. And sadly, many unprepared investors have faced a complete loss of their funds simply by making wild, speculative bets with money they just couldn't afford to lose.
Section 4. Crypto versus traditional finance. Truly two different worlds.
Think about the classic Warren Buffett philosophy for traditional investments for a second. You buy productive assets that generate value over time, like dividend income, backed by strong regulatory oversight and generally lower volatility. Now, cryptocurrency operates on a totally different wavelength. It's driven by high growth potential, rapid blockchain innovation, 24/7 continuous trading, and yes, heavy speculative sentiment. But here's the thing, these aren't enemies. A smart, balanced investor utilizes both to serve fundamentally different purposes.
It's kind of like building a tiered cake. Your foundational layers, those are your traditional secure assets. You should treat cryptocurrency as the frosting, or maybe the cherry on top. It's a high-risk, high-reward supplement, absolutely not the foundation of your financial plan. It should complement a sound, diversified traditional financial strategy, not replace it.
Section 5. The Beginner's Playbook. Investing with discipline.
Before you buy even a single fraction of a digital coin, you really must walk through these non-negotiable steps. Step 1. Ensure you have a fully funded emergency fund in cash. Step 2. Get any high-interest debt entirely under control. Step 3. You need to already have a diversified traditional portfolio in place. And finally, Step 4. Only allocate money you can afford to leave invested for several years. Or, actually, let me rephrase that. Only invest money you can afford to completely lose. That right there is your bedrock.
And once you've actually started, you need to adopt the mindset of Sarah, another investor highlighted in our sources. She viewed Bitcoin exclusively as a long-term, high-risk investment. When the market corrected, and trust me, it always does, she maintained her discipline. She completely ignored the short-term emotional panic, didn't react to the crazy daily news cycle, and just let her long-term thesis play out. Successful investing here is rarely about predicting short-term price movements. It's all about staying patient.
On the flip side, you must actively avoid these devastating, all too common mistakes. Never, ever invest without doing your own research. Please, don't just buy a coin because some social media influencer promised you a private jet. Stop chasing quick profits out of FOMO or the fear of missing out. Never ignore your portfolio diversification. And please, do not neglect cybersecurity. Use strong passwords, two-factor authentication, secure wallets, the whole shebang. And above all, try to avoid emotional investing driven by fear when prices drop and greed when they skyrocket.
As we wrap up this explainer, I want to leave you with this really powerful quote drawn directly from our source material. In the rapidly changing world of digital assets, knowledge, patience, and risk management remain your greatest investments. It perfectly summarizes everything we've broken down today. The tech might be new and flashy, but sound financial principles, those literally never change.
Which leaves us with one final, pretty provocative question for you to ponder. We've seen the data, we've outlined the playbook, and we fully understand the intense volatility. So ask yourself, are you disciplined enough for cryptocurrency? Take some time to think about your financial readiness, your emotional control, and your long-term goals. Thank you so much for joining me for this explainer. If you found this breakdown valuable, keep learning, stay informed, and always let research, not hype, guide your decisions. Catch you next time.